Cryptocurrencies, crypto, are popular not only because it has generated many millionaires overnight, but it also addresses the need for a decentralized government, especially after the news about GME stock. A bubble is fueled by enthusiasm, but it is not always the case. Welcome back everyone. In this video, we will define crypto, dig deeper and understand how blockchain technology works and, in the end, we will discuss the price fluctuations of Bitcoin that may lead to a crash. A cryptocurrency is referred to as a digital currency that is secured by cryptography. This makes it near to impossible to counterfeit or double spend. These various cryptocurrencies are decentralized networks based on blockchain technology. The distinctive feature of all cryptocurrencies worldwide is that they are not issued by any central authority, which means they are secure from third-party manipulation. Cryptocurrencies are systems that aim for safe payments online, which are regarded as virtual tokens. The term crypto refers to the various encryption algorithms and cryptographic techniques that safeguard these entries. Blockchain technology, in simple terminology, is defined as a decentralized, distributed ledger that records a digital asset's provenance. Provenance enables businesses to collect and combine data, including open data, and verify every physical product via a digital passport that proves authenticity and the origin on an immutable ledger called blockchain, thus creating auditable records. Blockchain is usually referred to as a distributed ledger technology (DLT). It makes the history of any digital asset unalterable and transparent through decentralization and cryptographic hashing. A hash is a mathematical function that converts one value input to another. Hashing data is a common and good practice and is fundamental for security. When you hash a password, it is hard to figure out. If there is no hash, then anyone can see your credentials if they have access to the database or file. To grasp the concept of blockchain technology, think of a Google Doc. When we create a document and share it with a group of people, the document is distributed instead of being copied or transferred. This creates a decentralized distribution chain that gives everyone access to the document at the same time. On the other hand, no one is locked out for awaiting changes from another party. The modification to the document is taking place in real time, hence making changes completely transparent. Blockchain is a revolutionary technology as it helps to reduce the risks related to cybersecurity, stamps out frauds, and brings transparency in a scalable way for countless uses. It is essential to dig deeper and understand how exactly blockchain work. Blockchain consists of three important concepts, which are blocks, nodes, and miners. Every chain consists of multiple blocks. A block represents the present, and contains information about its past and future. They are used to store information related to transactions that occur on a blockchain network. The block becomes part of the past and gives way to a new block in the blockchain each time a block is completed. The completed block is a permanent record of transactions in the past, and the new transactions are recorded in the current one. Each block has three essential elements: the data in the block, a 32-bit whole number called a nonce. The nonce is randomly generated when a block is created, which then generates a block header hash. A block header is used to identify a particular block on an entire blockchain and is hashed repeatedly to create proof of work for mining rewards. Thirdly, blocks have the hash, which is a 256-bit number wedded to the nonce. It must start with a massive number of zeros in order to be extremely small. When the first block of a chain is created, a nonce generates the cryptographic hash. The block's data is considered signed and forever towed to the nonce and hash unless it is mined. Miners create new blocks on the chain through a process called mining. In blockchain, every block has its unique nonce and hash and references the hash of the previous block in the chain, so mining the block isn't easy, especially on large chains. Additionally, mining can be expensive and takes a lot of computing power. Miners use special software to solve the incredibly complex math problem of finding a nonce that generates an accepted hash. As the nonce is only 32 bits and the hash is 256, roughly 4 billion possible nonce hash combinations must be mined before the right one is found. When that happens, miners are said to have found the golden nonce, and their block is added to the chain. Moreover, making a change to any block earlier in the chain requires remining not just the block with the change, but all of the blocks that come after. This is the reason behind the challenging nature of manipulating blockchain technology. When a block is mined successfully, the change is accepted by all of the nodes on the network and the miner is financially rewarded. One of the most critical concepts in blockchain technology is decentralization. No one computer or organization can own the chain. Instead, it is a distributed ledger via the nodes connected to the chain. Nodes can be any kind of electronic device that maintains copies of the blockchain and keeps the network functioning. Nodes contain data and all nodes on a blockchain are constantly exchanging the latest blockchain data with each other on a network. Every node has its own copy of the blockchain, and the network must algorithmically approve any newly mined block for the chain to be updated, trusted, and verified. For instance, the miner who solves the puzzle first shares the result across the other nodes. Once the block has been verified, the nonce has been generated, and then the nodes will start granting their approval. If maximum nodes grant their approval, the block becomes valid and is added to the blockchain. Since blockchains are transparent, every action in the ledger can be easily checked and viewed. Each participant is given a unique alphanumeric identification number that shows their transactions. Combining public information with a system of checks and balances helps the blockchain maintain the integrity and creates trust among users. Essentially, blockchains can be thought of as the scalability of faith via technology. It is essential to grasp the concept of blockchain technology and cryptocurrency mining to better understand the nature of these digital assets. As the name suggests, cryptocurrency mining is time-consuming, costly, and occasionally rewarding. However, people are interested in mining due to its magnetic appeal towards miners as they are rewarded with crypto tokens. Let's take the example of Bitcoin mining. Bitcoin miners receive Bitcoin as a reward for completing blocks of verified transactions that are added to the blockchain. This process requires the miners to have a GPU, graphics processing unit, or an application-specific integrated circuit, ASIC, to set up a mining rig. If you are looking to mine Bitcoin, you can always use the option of Raspberry Pi. Raspberry Pi is a series of small single-board computers that runs on Linux operating system and is developed in the United Kingdom by the Raspberry Pi Foundation. Raspberry Pi 4 can generate 108 hashes per second. Hash rate represents a way to measure the Raspberry Pi's performance processing power. Let us take an example of XRM token. A device with 108 Hs can mine about 0.00005127 XRM per day. At $154 per XRM token, that allows you to make around $0.07156 per day. This example assumes your electricity usage is free from charge. However, if you don't have solar panels, you are paying your electricity provider about 5 cents per kWh since Raspberry Pi consumes between 10 to 15 watts of power. Additionally, Raspberry Pi is good for people that want to learn programming. You can also resell your Raspberry Pi projects or incorporate it in a commercial product. Since Raspberry Pi is open source, meaning that anyone is free to use it, you don't need a license. In my hardware and software architecture class, a group of students were able to sell their Raspberry Pi project to a security company. Their project was a mini car that you can control remotely and has a camera attached, which was also similar to my group project too. But you can do a lot of things with Raspberry Pi. Now, let's switch our focus to Bitcoin price fluctuations and crashes. Buying Bitcoin carries some well-known risks. Essentially, Bitcoin investment is similar to other high-risk and high-reward investments. This means whether or not you should be investing in it depends on your risk tolerance and your investment goals. A risk tolerance assesses how much risk you can handle emotionally and is one of the first things you should consider before making any investment. Cryptocurrencies are mostly a gamble, in the sense that it is an investment that could crash at any time. But this depends on your approach when it comes to investing in crypto. When we talk about trading cryptocurrencies, the common understanding is that you're buying them for short periods of time in the hopes of making huge profits. However, a lot of traders lose money. When we talk about investing in cryptocurrencies, an investor does lots of research, plenty of due diligence, DD, and is betting on the long-term success of a project based on the objective strengths of the team, the idea, and the market as a whole. There are techniques and methods such as catalysts, Visa using cryptocurrencies, universities and companies buying cryptos, CEOs such as Elon Musk endorsing it and cryptos skyrocketing after word of mouth from other crypto investors on forums, subgroups on Reddit and other networks, mathematical calculations, diversification, following crypto-related news, minimizing trading costs, and identifying patterns. Another way is ICO investing. An initial coin offering, ICO, is the cryptocurrency industry's equivalent to an initial public offering, IPO. A startup is looking to raise money to create a new coin, app, or service related to crypto or blockchain and launches an ICO as a way to raise funds. Interested investors can buy into the offering and receive a new cryptocurrency token issued by the company. This token may have some utility in using the product or service the company is offering, or it may just represent a stake in the company or project. Some ICOs have yielded massive returns for investors. Numerous others have turned out to be fraud, have failed, or performed poorly. To participate in an ICO, you will usually need to purchase a digital currency first and have a basic understanding of how to use cryptocurrency wallets and exchanges. Another strategy to trade crypto is to have multiple platforms such as Binance, Coinbase, or BlockFi, since one platform may crash, and it is essential to have access to a digital asset that is highly volatile. I see many people use Webull and Robinhood to trade crypto. If you're using Webull and Robinhood to trade crypto, you don't own the coin. Thus, you are just trading it on there and cannot transfer it to a wallet. It can be stated with confidence that the peak prices Bitcoin has reached in recent years is highly speculative. Economist David Rosenberg points out that the peak prices in 2020 are a massive bubble driven by a herd mentality, and I share the same concerns and believe it too overvalued to be considered a good investment. This factor may lead to a Bitcoin crash in the coming years. With that said, whether the currency will prove to be a significant investment or just a passing storm is hard to predict, and in the end, it all comes down to your appetite for risk. Thanks for watching. Please like, share, and subscribe if you want. Do you think crypto and blockchain are the future? Let me know in the comments. And check out the description below for some free stuff. See you all next time.